From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Farrell. Bloomberg Real Yield starts right now. Coming up, an inflation slowdown lifting sentiment, triggering a relief rally across risk assets and pushing back against hawkish central banks. We begin with the big issue, questioning the Fed's credibility.
Markets are completely ignoring Fed speakers.
The market is not listening.
They don't want to hear it.
La, 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 la.
I don't really care what the Fed's going to do.
The Fed was obviously late to the game.
I think they're fighting the Fed.
We've gotten this risk-on rally.
Credit's very strong right now.
The equity market and the credit market.
The market is a little optimistic.
A lot of that sentiment, though, has been built on this better than expected data.
Ping-ponging back and forth based on one data point.
Congratulations, we had record high inflation. We just didn't add to it.
1 month does not make a trend.
The debate on inflation has peaked. I think that's over.
This whole move this year is about reestablishing the Fed's credibility.
The Fed isn't driving this ship.
Joining us now on this issue of the Fed's rhetoric versus the markets is a Bank of America reunion. It's Invesco's Kristina Campmany, Maureen O'Connor of Wells Fargo, and Mike Contopoulos of RB Advisors. I want to start with you, Maureen, about what you expect from what we've seen so far, this feeling that markets have that they are ahead of the Fed. They see disinflation even as the Fed talks up rate hikes. Would you fade the rally we've seen in credit as well as certain tenors of government bonds?
Yeah, I mean, I think certainly the credit markets have benefited from this most recent injection of market optimism. I mean, even leading into the numbers this week, the investment grade space had been on, call it a 3-week-long rally in spreads. And it appears likely that will continue as we kind of press into the end of the summer. That said, I think there are plenty of flags here. The data this week suggested we've seen peak inflation, but I think the market is ahead of itself, assuming that, we should take any kind of victory lap here. We still have extremely high 8.5% headline CPI. There are components of core inflation that the Fed does have within its control that are still running very, very hot. So I think, this market perhaps is a little bit prematurely calling the end of this tightening cycle. And therefore, we do see some additional catalysts for headwinds in the investment grade market to come.
Kristina, do you agree?
We do. I think in rates in particular, we're pricing a very optimistic, this perfect soft landing by the Fed. So I think the rates market treasuries could be biased a little bit higher. And we've certainly seen the relief rally as we ping pong between the data of are we concerned about recession risks or are we concerned? And I think it's exactly right. One of the clips that you played earlier, one data point doesn't make a trend, and the Fed is going to look at the whole picture of data of what comes in the next month to really determine their path going forward.
I was waiting for one of you to recreate the la 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 la, which is the other aspect of that segment that really highlights some of the feelings. Mike, I suspect you guys are all going to agree with each other since you work together on the same floor in Bank of America. But I do wonder whether you feel that there is one tenor of the credit markets, one tenor of the debt markets in general, that is more perhaps optimistic than all others.
Well, listen, the bond market and the equity market seem to be diverging a little bit here, right? I mean, if you look at the inversion of the curve, you look at long end yield, they've come in quite a bit. That marks a big difference from what happened in March when the entire yield curve went up. Just 2 years went up more than 10 years. This time, the yield curve's going down in the back end of the curve. So longer dated treasury yields are saying, listen, there are some growth concerns out there, which makes a ton of sense, right? I mean, look at manufacturing PMIs, service PMIs, building permits, ISM new orders, consumer confidence, copper, the yield curve. Like you almost name your measure and things are getting worse, not better. And the long end of the treasury curve is reflecting that. And so there's definitely a bit of la-la land that's going on. I actually think there's tremendous opportunity in the long end of the treasury curve. Probably the 20-year, quite frankly, looks phenomenal. I mean, it's yielding 25 basis points more than the 30-year. Liquidity will find its way to the 20-year if the economy actually rolls and if profit growth turns negative, which is what we expect on the equity side by Q4 or the first half of next year. So I think there are opportunities out there, and I think there's a big divergence between what the markets are telling you. And I think the opportunity right now is actually in the long end.
Mike, you raise a fascinating question, and it has to do with the yield curve. The team over at TD warning of further curve inversion, writing, quote, the longer the inversion continues, the more investors as well as consumers will become nervous about a recession, and that might have almost self-fulfilling consequences. Maureen, you were talking about how you think that perhaps investment grade in particular has gotten ahead of itself, but more broadly, is what Mike is talking about really seen in the divergence between an inverted yield curve that is still deeply inverted and credit, which basically seems to be suggesting that companies are in a better position, that even the most precarious of borrowers are having a more credit-worthy moment?
Yeah, I mean, listen, I think, the appetite for credit has been a little bit uneven to start the year. I think when you dig into the details of investment grade, there was a very clear decompression across the ratings to start the year, in that there was a preference to up in quality as rates continued to sell off. Investors were using that as an opportunity to up tier in asset quality at higher yields, to the detriment of some of our weaker BBB names. You have seen that reverse maybe a little bit in the last couple of weeks, and same goes for high yield. A massive amount of decompression across the ratings to start the year, and now you're starting to see some of the weaker rated names get a little bit of an uplift here. So again, risk on means that investors feel more inclined to reach further down the credit spectrum to pick up yield. But again, it does feel like the last shoe hasn't dropped here yet, with respect to the Fed's tightening plan. And that will impact certainly technicals in our market. So we do advise, proceeding with caution on some of the riskier asset plays.
It's so confusing right now because on one hand, you have the enthusiasm in markets, you have the inverted yield curve, and then you have the path to the faith that people have that the Fed can get back down to that 2% inflation rate. Take a listen to what Citigroup had to say. They said that the market is not quite understanding what the Fed is going to do. Markets have structurally underestimated the threat of sustained higher inflation. We continue to expect a 75 basis point hike in September and policy rates reaching above 4% in early 2023. Kristina, this is what the market is pushing back on. They don't see this as a reality anymore. Do you think that the market's benign reaction to what we've seen so far will make it more likely that the Fed will actually take a harder line to prove to the market they still have teeth in this and they're not going to let conditions really loosen that much?
I think it's absolutely the market and the Fed is going to focus on what financial conditions are pricing. So this easing in financial conditions in the last week with the bounce in the equity market and the credit market, is that concerning to the Fed and what they're trying to do? I think it is. But I think, again, I go back to, I think the market's pricing this very soft landing and a great confidence in the Fed to be able to deliver that. You look at inflation markets and tips markets, we price a very benign outcome for inflation 1 year, 2 years forward, and an ability, a belief that the Fed can get us back towards that 2%. And the market seems to be looking at this hiking cycle similar to what we've had for the last 30 years, which was really a period of falling inflation where the Fed hikes and immediately cuts. And I think our difference of view this time around is the Fed's going to hike, but not really, we're not going to deliver those cuts that are priced into 23. But I think this market pricing is taking out that tail of 4% or higher Fed funds a year out.
Mike, to that point, as Kristina's talking, I wonder how much Fed officials are going to try to be more aggressive, if not in rhetoric, even in action, simply because financial conditions have been easing. And they've been easing substantially. They've taken out hikes and they've taken out a lot of the tightening that had been achieved earlier. How much more likely will there be a Fed call on this market rather than the Fed put that a lot of people have gotten comfortable with?
Yeah, there's no Fed put here, right? That I think has become very, very clear. Think about, just last week, all the different, or maybe it was 2 weeks ago, all the different Fed governors coming out and basically saying you completely misinterpreted, Powell's press conference and what we're going to do. And I think you bring up a great point, Lisa, which is you're going to see most likely a lot of rhetoric around the inflation job is not done, probably around Jackson Hole. We've got much further to go. You're seeing Kashkari talk about it. You're seeing some of the more doves come out now and saying, listen, market, we're going to hike for a while and we're going to hike pretty aggressively. And we don't care what the equity market does. And in fact, we hope the equity market and the froth in crypto and in areas of the credit market and areas of the equity market like spec tech, we hope those things come down, right? And by so doing, we're going to tighten financial conditions and the market's going to help us. And listen, I just think that, whether it's credit, whether it's equities, the world just hasn't woken up to that yet. But listen, this is not that atypical. I mean, right, whether, again, it's on the equity side or the credit side, bear market rallies happen all the time. Optimism abounds. People like tighter spreads. People like higher equity prices. And, that's okay. That's pretty normal. And it's probably not going to end well for a lot of people who are entering into the trade today.
Love it, Mike. That's okay. If people want to go there, go for it. Have a nice time. It's not going to end well. Kristina Campmany, Maureen O'Connor, and Mike Contopoulos, you're all sticking with us. Up next, the auction block, a slowdown in inflation triggering a host of deals in high grade. That conversation coming up next. This is Bloomberg. Abramowicz in for Jonathan Farrow. This is Bloomberg Real Yield. Time now for the auction block, where we kick things off in Europe. Volvo giving the market a pulse in a quiet week of just 2 billion euros in sales. Weekly volume falling to the lowest level this year. In the United States, high-grade bond sales heating up with 20 issuers coming to market. Credit Suisse and Duke Energy pushing weekly issuance past $30 billion. And the junk bond market staying in its summer lull. Just 2 deals coming to market, taking monthly sales to $3 billion in the slowest August since 2008. Sticking with credit, Neuberger Berman's Ashok Bhatia weighing in on where he sees opportunities.
For credit markets, and this is non-investment grade, investment grade credit, mortgages, there's still more room for we think these spreads to tighten. Probably at this point, best opportunities are in the non-investment grade market, but also things like, short maturity financials and banks. There's more total return right now, we think, coming from some credit income and credit spread tightening than that we'll see a big drop in interest rates from these levels.
Still with us, Kristina Campmany, Maureen O'Connor, and Mike Contopoulos. Kristina, I want to start with you with this question of where you do allocate your cash, where you do see opportunities at a time where the market might be getting things wrong. I know that there has been a lot of skepticism about some of the higher leveraged assets, but is there an area where you think perhaps there are some pretty big opportunities, whether it's less liquid debt or whether it's in higher rated credit?
So the places where we see opportunities are on the emerging market side, particularly EMFX versus a basket of DMFX, whereas the dollar versus the euro and yen still remains a little bit more challenged as there's that policy divergence focus. And emerging market rates actually are also starting to look attractive to us. We've historically, whenever we have these periods of wide differentials, like above 4% between EM rates and DM rates, they historically correct quickly. So those are the 2 places that we're focused on at the moment.
Maureen, emerging markets, is that a place of opportunity?
I think tactfully, there are still ample catalysts for market volatility, both from the Fed and otherwise. And I think it tends to impact our highest beta names the hardest when things do turn south, and that can clearly have a larger overhang in EM debt. So at least for us, I think our tactical plays are more around higher quality investment grade credits, larger, more established names, both in the domestic and developing world.
Mike, from your perspective, I know you were talking about 20-year treasuries, which was a favorite spot of a lot of people who saw distortions in terms of how inverted that yield curve with 30-year yields were. I'm wondering if it's really mainly in the treasuries or if you too are finding things places to buy, even in investment grade that's rallied so much.
Yeah, so straight run-of-the-mill credit is not my preference at the moment. I mean, listen, if you thought we were going through a mid-cycle slowdown when high yield got to 600 basis points, it's always a buy. You always buy high yield 550 to 600 basis points if it's a mid-cycle slowdown. If it's not, and it's the end of the credit cycle, you would never buy it there. So we think the rally, sure, maybe it has a little bit more to go, and my guess is that it maybe has another 2 weeks or so to go. But over the next 6 to 12, spreads are likely to be wider, not tighter. And I think that goes for most of the IG market and the high yield market as well. It's not going to be a bad credit cycle. I mean, corporate fundamentals are actually quite good, but you are going to see wider, not tighter spreads, I think, on a longer term basis. I do agree. I think it was with Ashok, front end bank spreads, floating rate, certainly are a good place to maybe park some cash, pick up a little bit of yield. AAA CLOs, we think are quite attractive. You get the floating rate aspect. You had a reset of LIBOR that caused yields to go up quite a bit there, and an incredibly safe structure. So I think AAA CLOs paired with a long duration treasury is like the perfect barbell, and that's where we like at the moment.
Mike, you flicked at something, and since it's Existential Friday, I want to hone in on it a little bit when you're talking about it's not a very bad credit cycle. Is it going to wash out some of the zombies in the market, or is this going to be just a little dip that really isn't felt to its full extent because of how much debt people have refinanced, pushing maturities out into the future?
I think that's likely absolutely right, the latter. Everybody refinanced debt in 2020 and 2021. I'm sure Maureen was incredibly busy. As everybody pushed out debt, locked in very low long-term interest rates. You look at interest coverage on the IG market or the high yield market, it's never been higher. Cash on balance sheets has never been higher. And so, that's going to help. And so we wouldn't expect a default cycle similar to what we've had over the last several default cycles. Like, it wouldn't shock me if you get to, 5, 6, 7% default rates at the peak, which is quite different than what you've had in the past. And so, listen, there's going to be great opportunity in credit. Private and public markets. It's just not today. Maybe it's in 3 months, 6 months, 9 months, but there are going to be tremendous opportunities because you always get the baby thrown out with the bathwater. You always get people to expect the worst. We haven't had capitulation yet. You know how we haven't had capitulation yet? It's because everybody's asking, when are we going to buy? When's the time to buy? Is it time to buy now? That's not capitulation. Capitulation is not when you ask if it's time to buy. Capitulation is when you hide under your desk and you refuse to buy anything. So we're waiting for that capitulation moment in credit. That's going to create a tremendous opportunity because it's just not going to be that bad for all the reasons you mentioned.
So since people are not hiding under their desk, Maureen, there are people who are actually raising money and companies issuing in the investment grade space. Are they doing so opportunistically, or are they doing so because they don't really have a lot of other options and they foresee higher yields down the line?
I think it's a little bit of a mix, to be honest. I think issuers that have, let's say, a 3 to 9 month funding need on the horizon, they have been waiting for these pockets of opportunity like we're in right now, where we've had, sort of a sustained period of positive spread momentum to go ahead and take advantage of that environment, knowing that there's plenty of headwinds, potentially in our future here for the back half of the year. So we have seen a big rush to the investment grade markets in the last few weeks. In fact, we've priced $160 billion of primary volume in the last 4 weeks alone, $90 billion in the month of August, which is seasonally, typically a quieter month for us, certainly in the back half. So no question, there is a little bit of opportunism in those borrowers that are looking to de-risk some of their nearer term funding needs. And then there's, capital constraints in the bank market that I think have encouraged some of our issuers to think more carefully about accessing the bond markets. When you think about this, again, this window of positive spread momentum, it also comes against an environment of lower treasury yields from where we were, call it a month and a half ago. So yields on the investment grade index are, close to 50 basis points lower over the last month and a half. There's an opportunity to come in here, access the debt capital markets at what are, certainly much better fixed cost of funds versus where we were to start the summer.
Maureen O'Connor, Mike Contopoulos, Kristina Campmany, everyone sticking with us. Still ahead, the final spread, the week ahead, featuring a host of Fed Speak and the latest meeting minutes. That conversation coming up next. This is I'm Lisa Abramowicz in for Jonathan Farrow. This is Bloomberg Real Yield. Time now for the final spread, the week ahead. Coming up, U.S. housing numbers coming on Tuesday, retail sales and Fed minutes out on Wednesday. More Fed Speak. We've got Esther George and Neil Kashkari on Thursday, followed by another round of initial jobless claims. And finally, Richmond's Fed Barkin speaking on Friday. This has been the issue, and I'm so glad that you're all here. We want to get to the rapid fire round before we get to all of the data points that are coming up this week. And I want to start with which you prefer, the United States or the European credit markets. And I want to start with you, Kristina.
We've been liking some of the European markets better, especially financials. AT1s have come this year, some yielding upwards of 9.5%, and we think there's opportunities there.
All right. What about you, Maureen?
I think selectively across European credits, like Kristina highlights, but we're still staying a little bit closer to home here in the U.S. Okay. Given the lack of supply in the European market, you have seen quite a run up in some of the valuations over the last few weeks.
Mike, what about you?
I like U.S. credit more than European credit. I would rather, especially if you extend it out to sort of broader fixed income. I like agency mortgage debt, as well as I mentioned earlier, AAA CLOs, and those are pretty uniquely U.S. products.
And you all kind of answered this, but just to sort of to consolidate all of the answers, where do you expect better returns over the next 6 months, investment grade or high yield? Maureen, I'll start with you.
So I would say investment grade. I mean, I think there's still headwinds in both sectors, and we expect returns to continue to deteriorate in both asset classes. But as we get closer to this weakness becoming less of a technical issue and more of a fundamental issue, more of a credit issue later on in the tightening cycle, that's when we expect high yield to underperform. So we would go investment grade over high yield.
Mike, I have a feeling you're the same.
Agree.
All right. And Kristina, you as well?
We'd also echo an IG bias.
All right. So my third question to you all is, have we seen peak yields in the U.S. 10-year Treasury for this cycle? Michael, I'll start with you.
Yeah, I think we have seen peak yields. So,
Maureen?
We agree. Upward pressure from here, but we think the peak is behind us.
Kristina?
I think we can test 350 again in 10s, but that probably is the peak.
All right. And before I let you go, we did touch on the week ahead, and I am curious if there is a data point that you're looking at, particularly with retail sales coming up, or if it really is going to be quiet until Jackson Hole. Mike, what's your view?
Yeah, I think retail sales are an important indicator. I mean, you never want to look at just one. But if there's one thing that I continue to track, it's jobless claims. Every other area of the market has shown cracks, is already contractionary territory or slowing, but the jobs market's incredibly healthy. It'll be the last shoe to drop. So for me, it's looking at jobless claims every week and seeing if there's an inflection point or not.
All right. Well, my thanks to all of you, Kristina Campmany, Maureen O'Connor, and Mike Contopoulos. We really appreciate you taking the time in a week where there was a massive pivot by the market in the belief that the Fed would pull back from some of the rate hikes, completely winding back some of the inflation that they'd been expecting. All of our panelists said it is too soon to say that. Many analysts have said that. And yet you have others coming out and saying the market has been right, the Fed has been wrong, the market's been out front. Next week, we will get the latest read with those retail sales and those jobless claims from New York. That does it from us. Same time, same place next week. This was Bloomberg Real Yield. This is Bloomberg.